Very good. So SDR, specialized debt restructure. So this is a recent development in the banking world. It's been one of my key focuses over the last 2 years to engage with regulators, and it's a really interesting process. I was quite accustomed to unaccustomed to speak with the European regulators. The Swedish FSA I've been in touch with in my previous jobs quite a lot. So I can become quite nerdy around this and talk for hours, but that's not the intent here. I'll try to give you an overview of our interpretation of both the legal text, what it means for us, and also the meetings that we've had with the European Banking Authority, the Commission, the Parliament, and clearly the Swedish FSA in this process, since we understood that this is coming. So this section is designed to give you the regulatory context behind this development. It's also to explain the backstop rules. It's not that evident to many people. It's a complex banking lingo that we would like to try to simplify, and then also outline the current impact and what it means for us, this regulation at this point. The SDR criteria, there's a number of criteria that needs to be met to qualify. And then that impact, what does these criteria have on, what kind of impact does it have on us? And then I'll try to put it together in a summary in the end. So regulatory context. I think following the banking crisis, a new area of regulatory development was introduced. So the two key regulatory objectives in my mind would be financial stability and also protecting the taxpayers and the depositors from a unhealthy or banking failures. So what they did was to raise capital levels, so regulation around capital. They made sure that the liquidity was there, so LCR is the regulatory measure, so a lot of short-term capital to meet short-term outflows from depositors, stability of long-term funding, and then also transparency in reporting. So these four are the cornerstones in the banking regulation. And also in this crisis in 08-09, there was a large buildup of NPLs, which continued then later in what was then called the PIGS crisis, and that then amounted to the peak in 2015 that Andrea was referring to before. And as part of this build-up, there was a number of legacy in the banking sector, so zombie banks that didn't deal with the NPLs as forceful as the regulators wanted it to. So that means, from a societal point of view, that the banks were unable to finance our societies in up and down terms because they were so focused on dealing with the bad balance sheet. So there was a growing need to deal with all of these NPL problems, and the European regulators started a action plan to deal with this issue. And they were clearly, as anyone, I would think, starting from the top. So what is the key priorities? Healthy banking sector. And that's what the regulation started with in what came about in 2019. So forward-looking credit losses, IFRS 9, prudential backstop, which will I come back and explain, creating NPL markets that were more deep and liquid, the prudential backstop. And the most important thing for us in this was creating liquid NPL markets and forcing the banks to sell. That's a really positive for us, which supports our investment business. And then the challenge that we had to deal with was the prudential backstop, clearly. The principle behind the prudential backstop is that the longer exposure has been non-performing, the lower likelihood that you will get back a high amount. So that's the whole principle why they've done it like this. I'll come back to what it means in practical terms. In short term, the backstop is very easy. So it's a set timetable when you have to put aside capital to cover your losses, basically. Just as a reference, the backstop is applicable for all claims issued after April 2019. Everything before then is not hit by this. And it's also clearly just applicable to banks or bank-regulated entities. I think it's important to say that we fully support this. This is completely in line with our objective, what we try to do as a firm. And basically it ties very well to our purposes: support the healthy banking sector, and then help the consumers back to the financial system. The next step for the regulators was to create a better functioning MPL market, so high liquidity, the right market participants, and during COVID. I don't know if you followed the industry that closely, so you knew that the regulators issued another action plan, and that was in the trying to see the implications of COVID. They were very worried that there would be a massive buildup of MPLs. So as part of that report, they wanted to establish a new segment of the MPL market. They were calling it removing impediments for bank restructurers. And this is what then led to eventually to the SDR. And I think in our interpretation, the specialized debt restructurers are seen as a stable and a very productive participants in the MPL markets. So it's adding to the buy side with attractively financed companies that can help the banks. So offering them everything else equal, higher pricing for the MPL portfolios, and then a stability to that industry as well, to that market better. So it's improving market functionality and then increasing the competitiveness of this market. And if you go to the next page, we will see how the prudential backstop works. So we've touched on how a MPL works, what drives the level of money that you can expect to get back. It's basically the type of claim and the age of the claim. So secured, it's very likely that you will get more back because it's a guarantee or a house behind it normally. So we invest in resi mortgages. And then if it's unsecured, it's less. And then with age, it's less probability that you will get a higher amount back. And this is exactly what this does. So unsecured, if you haven't dealt with an unsecured claim that you've been facing as a bank with as an MPL, then after 4 years, you need to write it off completely. You have no choice. It's a regulatory standard. It's a set schedule. They force the banks to do this. And it's designed to encourage selling it to a specialist like Hoist Finance. Same thing for secured. However, that's more complex. It takes much more longer time because you have a security behind it. And it's also a slightly more complex regulation in that one. But for us, that has very limited impact for us, if any, at this point. So this is in a nutshell what the prudential backstop is: a set time for the banks to write off their MPL claims. So they need to provide or write down these MPLs over this period. And this page is designed to show two things. One, how the required minimum loss coverage works. So that's what you need to set aside in this prudential backstop, and also to give a view and the impact of how much this impacts Hoist today. So when we buy, this is the current Q2 book. So it's not the same numbers as before, because the previous number in a similar chart was since inception of Hoist. This is the current book. So currently we have more or less 400 billion SEK on our balance sheet in original claims, gross book value. This is not the book value. This is the book value that you recognize if you've seen the last quarterly report. So 27 billion SEK. That means that, again, around 90% purchase price discount on what they here issued. Credit risk materialized, completely different asset. And then when you look at the required minimum loss coverage, you need to deal with two things. So if it's a sold MPL, you can use this as your write down or loss coverage, so to speak. So this discount can provide for that. It's allowed to do that, which is very logical, right? So because the risk is gone. So this is part of the minimum loss coverage. And then also what we haven't, all of this is not backstop clearly impacted claims. So part of this is backstop, and that's provided for in the discount when we buy things. And then as older and older our books become, and as older the portfolios after 2019, then more of the portfolios that we see in Europe will be backstop impacted. Because now it's 2024, so it's gone 5 years since these claims started to be issued in April 2019. So the cycle is that issued, then becoming a impaired credit, becoming NPL, and that's where the clock starts for this 4 years for unsecured. And then that clearly impacts. So if we would not become an SDR and we would just buy NPLs, they would in 5 years most likely all be under the backstop, prudential backstop regime. And then this would be equally sized as this in the end, right? So because it just builds up. However, until this date, we have very limited impact of the backstop. And that's the key reason why we haven't rolled out earlier solutions for the backstop. So we have other solutions than become an SDR. So a few years ago, we've had issued a securitization, which is a significant risk transfer. We will continue to do that, but more as a strategic product. You can do co-investments to deal with the prudential backstop. However, if you look at all the solutions that are available to us, then the SDR solution is absolutely the most attractive. So both on RE level, and so the returns are higher if we apply this status. The size, we don't need to share the investment with the external investor, so we will be larger and we will get all of the returns. So in every level, return, absolute size, the capital we will throw up because of that is better in a SDR world for Hoist Finance. And then just to state the obvious, the SDR is one thing basically. It's an exemption to the prudential backstop. So that's very simply what it is. And you need to meet a number of criteria, which is on this page. These are supposed to be ticks. It's in the presentation. It's a green tick. So meaning that we have these 6 criteria, and the first one, main activity being NPL acquisition and management. So the banking regulated entity needs to be focused on this. So the regulators, they do not want larger banks to be able to circumvent the prudential backstop, because then they can structurally get around it, push it into a daughter company or whatever it may be. They were very clear that this is something that is not something they are pursuing. So it needs to be really focused on being a bank, a debt SDR. And then for same reason, they put a 15% cap on owns originated loans. So these specialized banks are not supposed to lend money to the public or to companies to any larger extent. So when we become an SDR, we can, of the total assets, have 15% of own lending to private persons to refinance NPLs, or to co-investment partners. We can finance those to a certain degree, but it's limited on 15%. And then 5% purchased NPLs qualifies forbearance measures of the purchased NPLs. So the forbearance measure is simply put a change of the key terms of the contract. So if somebody comes into a difficulty in a debt situation, if you change the interest rate levels, if you extend the maturity, if you write it off, you change any material things in that contract with the bank, then it's under forbearance. And this clearly is, we tick this as well. I mean, this is our core thing that we do. We talk with our consumers, we try to make it work for them. The key is clearly the ability to pay back. If that's on average around slightly less than 20%, then basically the large majority of our claims is this. So we tick that one as well. Total assets, they don't want too many large, so they don't want too large SDRs. So they don't want to build in the risk of an SDR becoming so large versus a risk to the system. So this is 20 billion euros. we're not there yet. Ideally, we will get there some point, but it's not over the next few years. So currently, we have a book of the total assets around 30 billion or so, roughly. So we're quite far from that in SEK. And then the ongoing NSFR, so net stable funding ratio. This is the long-term stable funding. So this is what the banking sector put in place, or the regulators put in place to ensure that the long-term funding is in place for the banks. And this is normally 100%. So they hiked this to 130%. And this is something that will impact us. And I'll come back to that on the next page. And then sight deposits should be less than 5% of total liabilities. In our case, we don't have any sight deposits, so that's not a consideration for us. We have savings accounts and saving offerings. So this is more into transaction accounts connected with debit cards, that sort of thing. That would be the typical sight deposit. So what does this mean that we need to, the only thing that we need to develop now is a NSFR of 130%. And we said this in the Q2 report that after the board decided that we would aim to meet all of the criteria, including this, we would start to increase liquidity to meet this. And this was the Q2 actuals. We had an NSFR of 121%. This was its last 12 months leading up to Q2. It was 115, so it's slightly higher than normal. So if you would look at having a slight buffer to the 130%, so let's say 135, this is illustrative. So just to put that in context, we're going through always a yearly ICLAP process, so internal assessment, how much liquidity and capital, the risks around those, and that then guides our risk appetite, the limits, etc. And we still haven't done that work with the board. We'll do that over the next month and a half to see the internal limits, where how much risk appetite do we want or not to the 130% limit. But we used illustrative here, 135%. Then it's expansion with the same size of, this is supposed to be as a typo, so this is the same NPL portfolio. Then the total assets would grow 16%. So the liquidity portfolio would go from 11 to 15 billion SEK. And this clearly comes with some cost. And the funding plan to fulfill this is now during the second half of this year. And as I mentioned, we're in the market starting now and take a meet for a senior unsecured bond or two bonds. And the way we see it is that we will have, give or take, 80% deposits that will fulfill this new criteria for us, and then 20% market funding. So that will, as I mentioned, of all the alternatives long term, this is by far the most attractive. And if you would take a non-backstop world and compare it, then this would add more or less 65 million per year, and then 20 in 2024. And that's a very small part of our overall funding costs. So it is a really efficient way to deal with this and becoming an SDR. The increased liquidity buffer will draw some capital. It's very limited because it's very high quality paper. As I mentioned before in the liquidity portfolio risk, we will maintain high quality, highly liquid, so sovereign bonds, municipals, that sort of papers in this portfolio. Just to repeat what I said in the Q2 report as well. So what we've said about ROE and the full year outlook that we're given on that include this cost of SDR. So we've always said that if starting the year with that we plan and expect to hit our ROE target for the year, and that remains the case. And it's always been including this cost because we've had it on our radar. So summarizing, this regulatory status is in level 1 text, so it's regulatory in there. So it's not a directive which needs to be implemented into local law. It's across European law. And it's there to designed to stimulate the NPL markets overall. So the regulators want to make sure that we have a really liquid and deep NPL markets. It's an exemption from the prudential backstop, as I mentioned. And for us, if you look at the more conceptual level, it enables us to focus on what we do best, meaning helping the banks and then in the longer term, helping the consumers coming back to the financial system. So we don't have any distractions once we become an SDR. We can focus clearly on that. And that gives us a simplified business model, having securitizations, more complex structures that draws resources. It costs us. We need to share profits with an external investor. If you have an external investor, they want to be part of the decision making one way or the other, either by frameworks or by having a say on each investment, which is very complex. It lengthens the processes, etc., etc. So we have a much simpler businesses in an SDR world, and we also fully independent. And we've said this now since Q2 that we plan to qualify as an SDR by the 1st of January 2025. And we're in good progress to meet the 130 NSFR requirement, which is the final outstanding requirement that we need to fulfill. So I think just to summarize, I think we see this as a really recognition of the model of specialized debt restructurers such as Hoist from the regulator's point of view. So the way we interpret them is that they see the real value of these players being part of the NPL markets. It's the same high regulatory framework. They want to keep that. So it's all the consumers stay within a banking regulated framework. They really like that. They also like the fact that it's cheaper funding, so it can provide a competitive pricing to the banks. They don't need to, everything else being equal, write off as much on these NPL portfolios. So in summary, once we become an SDR, we will not be hit by the prudential backstop, and we will have a much more simple and full independence to focus on our core purpose, which is a really, really productive place to be.